That was President Trump at the White House earlier. He said a lot that we want to unpack with you. Are we in good shape when it comes to munitions?
You were in D.C. this week, right? At a big event.
We attended a conference called the Maclees Conference. Jim Maclees is an expert in bringing folks from the Department of War together, whether it's Army Secretary, Navy, Air Force, and critical weapon systems. And the theme there, very, clearly all appointed by the administration, so there's a view there. $1.5 trillion budget is going to come out from the president's request at the end of April and May. That's kind of new. It's delayed. Mm-hmm. We thought any day now, but we know it's going to be at the end of April, and they're sticking to their $1.5 trillion. And I don't know how Democrats will align with that. With that, President Trump's comments, I don't know if we're at unlimited stocks of missiles and munitions, but that's one thing that's clear from all the DoD employees, is all the Department of War folks, is that missiles is the best part of the market in terms of growth to invest in for investors. And that's why you're seeing 4x production increases. So what the Department of War has done, working with multiple primes like Raytheon, like Lockheed, is to put forward frameworks on missile production, saying over the next 7 years, we'll guarantee you production increases on a PAC-3 missile from 600 units a year to 2,000 units a year, wow, which is a big revenue bump. And we will guarantee that for the next 7 years. So can you build enough capacity to do that?
Can they?
Well, they're working on it, and I think that's a theme that the Department of War, more than anything, could align on, whether it's Republicans or Democrats, is that, there isn't unlimited supply. And what we do manufacture from a missile perspective is quite expensive. We're doing it in low quantities, so we have to do it in larger quantities and also find ways of manufacturing cheaper munitions and missiles.
The president's comments about what Raytheon is doing, building 4 factories, Lockheed building 5 or 6 factories, does that align with what these companies have said publicly?
Yeah, we're seeing 30% increases in CapEx for basically 15 to 20% of their revenues. We continue to see 8%, even though we're hold rated, 8% upside in our estimates if Raytheon and Lockheed could actually meet these frameworks. And those are only 3 that have been announced thus far. I think you'll see more to come. There's dozens of offensive and defensive missiles. We put out a missile primer today, and folks were emailing me, well, you missed this one. Well, you missed this one. I was like, well, there's so many opportunities to continue to invest. And I think that's one thing the government will agree on.
I mean, it's a whole supply chain, right? It's the suppliers. I mean, when you look at it, we obviously talk about the big defense companies, whether it's Lockheed Martin, whether it's RTX, but there's a ton of American companies, right, that are going to be impacted by this.
We're trying to find ways that might not be as obvious, that have also really great margins associated with it, and might not have to have the massive capital expenditures without the share repurchases. So like Woodward is a great way to play it. Mm-hmm. Solid rocket motor providers, even HEICO that does missile components, Elbit in Israel. So there's a whole slew of ways to play missile defense and offensive missiles.
So not just U.S., obviously, global.
And I would say Howmet and Woodward are great ways to play it that traditionally people might not think of.
Can I just ask you, what is the supply chain like for defense companies? Is it a global one?
No, it's mostly in the U.S. Okay. It's U.S., but what the government's trying to do is dual source it in the U.S. So having multiple suppliers, because the capacity increases are going to be pretty significant.
So I hear you talking about the opportunity that these primes have ahead of them. Yet as you mentioned, you still have a hold rating on RTX, Northrop Grumman, Lockheed Martin. What would prompt you to change those to buy ratings?
I think the Department of War, one of the things that they've done is has guaranteed the top line, but they haven't guaranteed margins associated with it. On top of that, the primes have to invest their own capital, cut their repurchases in order to invest in the CapEx themselves. So at the end of the day, it doesn't change their EPS algorithm much. It actually, keeps it the same, even though they're investing for the Department of War much more. And that was part of the executive order President Trump put in at the start of this year. He said, I'll give you these frameworks, I'll boost the budget. But we haven't seen margins associated with it. And of course, some visibility as they finally have 5-7 year contracts should be helpful in margins. Then they don't have to renegotiate a contract term every year.
Having said that, we have an administration that when it identifies something as important to national security, they get kind of more aggressively involved, whether it's the semiconductor space, whether it's rare, earths and rare minerals. And I just wonder, is there something more that we would anticipate from this administration, when it comes to defense companies, whether it's taking a stake, making some further investments? I'm just curious what you are hearing.
I think they'll continue to do that, whether it's providing frameworks, so they'll allocate the dollars so that it'll be big contracts, so the primes will have no choice but to invest. It won't be, kind of wishy-washy, like we're only going up 5. It'll be 600 to 2,000. So the CapEx investment is needed, is critical. There's a 7-year time horizon. So first, we'll see more long-term frameworks.
Right.
Second, I think you could see some stakes. We've seen some of it already.
Yeah.
Of course, these primes don't have infinite capital, and they're already spending a big chunk of their CapEx now associated with missiles. So if there's more and more needed, you could see the government get involved.
Can I just ask too, shift to drones or more drones? I think this war has been fascinating. Well, fascinating is a bad word to use because it is war.
We've seen the way that it's fought different than previous wars.
Yeah. Is there a shift in terms of the kind of weapons that these companies want to be working on or are working on in the future? Or does that kind of get sidelined as a result of these orders from the government?
There's so much going on, right? So with Russia and Ukraine, I think you've seen 70% of the fatalities associated with drones. But that's not the kind of drone warfare the U.S. might use. So we'll need more maneuverability, more electronic warfare with drones. But the key, I think, whether it's missiles, munitions, or drones, is ability to manufacture it today, readiness, and scalability, doing it in the hundreds of thousands, not only 100 or 200 or 2,000 units even, which is what we've seen from at least Russia, Ukraine, Iran, is they manufacture missiles in the thousands, not smaller quantities like we do.
So how are you looking at magazine depth in the context of comments that we heard from the Secretary of Defense earlier today? He said in the Oval Office, missiles being shot are down over 90% since the beginning. One-way attack drones down over 90% since the beginning. The U.S. is going after Iran's industrial base. Does that mean a lot of the munitions that we've used up or have used, those will not be used in the coming weeks or months, depending on how long this goes, just because Iran's capabilities have changed?
I'm not sure how Iran's stockpiles look, but what we're doing is very expensive. I don't know how much the war is costing, but it could be $10 billion a day. So
$200 billion more is what, right?
Yeah. So over the last 18 days, it's very expensive what we're doing. So we have to, a theme is readiness, scalability, and also affordability. We can't manufacture shoot down objects with $5 million missiles when they have $50,000 missiles. So we have to come up with ways. And that's what's really driven this administration has been super supportive of startups, the defense tech names in the world. It's led by Anduril, that's more publicly known, but there's a whole bunch of names we cover, like Voyager, that are out there trying to take a piece of the pie that was previously not given to them.
Hey, I want to bring in a question from our Wayne Sanders, who we talk to a lot about. He's down in Washington and part of our Bloomberg intelligence team. But he said, which programs are most at risk of funding versus revenue due to execution or industrial bottlenecks?
That's such an interesting question because I asked Jules Hurst, who's the DoD comptroller. So think of him as the DoD CFO managing about $1.5 trillion. And this week I asked him, what do you think is going to get cut if the Democrats don't approve your $1.5 trillion budget? And he's like, I had a hard time getting to $1.5 trillion. I had to cut to get there. And I was like, the budget today is $1 trillion for context. So 1.5 is a significant increase. So the Republicans are going for full steam increases across everything, essentially. And I think historically what's been thought of as areas that will be reduced is F-35, a fighter of the past, or helicopter spending. And we're seeing that obviously come into the forefront of conflicts like Venezuela and even Iran, right? We're using older aircraft and the need for it, it's kind of reignited that need.
Can you believe we're talking about the F-35 as being something of the past, given how much we spent on it?
For investors, it was something of the past, but it's actually driven a revival in Lockheed stock, which has been leading the primes in terms of performance, as we've seen it used multiple times. So it's had a bit of a rebirth.
Okay.
All right.
Do we have time for a
30
quick question on airlines?
What do we need to know right now?
I think, basically this is a month of COVID for airlines in the Middle East. You're seeing capacity cut 80%. So a lot of work is being done on how does that impact global air traffic, up 5%, Mideast accounts for 10%. How does that hit, number one, global air traffic, global aftermarket demand? And then how does that hit sticker shock for folks buying airline tickets in the US as oil goes to wherever it's going to go?